Indian automakers back on track, albeit marginally, and why I'm bullish on this cybersecurity name. This is Vinayutham, your resident stock doctor, and welcome to a brand new episode 136 of the Stock Doctor podcast. Now, I have to apologize in advance, guys. This week's episode is going to be a short one, unfortunately. We're going to skip an entire segment, unfortunately, and this is because yours truly had a bit of an unfortunate accident last week. I had a fall, hit my face on the concrete on the concrete on the floor. Had some you can see a little bit of scars here, and you'll also notice that I'm not wearing any glasses today, and that's not because I've got contact lenses, but it's the fact that my glasses broke. So it's just the fact that I'm totally fine. Don't get me wrong. This is not like, oh no, guys, I'm in trouble. No, I'm totally fine. It's just that I've got a bit of a scarring on the side of my face, but the recovery, it certainly ate into my preparation time for this episode. So the point is the whole point is to keep the show's momentum going. And even if it means having to cut down on the content for the week and then make it up for it the week after, it's all about the momentum that's needed. That I want for the show, and that's why I thought so. That's why I'm just telling you. So it's going to be a very shortened episode due to a very, very unfortunate incident. So here's how it's going to go. There's not going to be a Doctor's Weekly Snapshot this week, but I absolutely promise I will do a very detailed segment, very detailed snapshot segment on the next episode, covering all of the details that have taken place in the last week, as well as next week. I might even do 2 episodes next week, whereby one episode is purely dedicated to Doctor's Weekly Snapshot, where we catch up on the last week's and the following week's developments. There's a lot to talk about in terms of the job market in the US not particularly doing great. Fed's independence, not Fed's independence, the independence of other government organizations under threat, and so on. So probably here, most likely it will be episode 137 will probably be Doctor's Weekly Snapshot alone, and then 138 will cover the next segment on Doctor Goes Home and Doctor Dissects, but it will be released at the same time. So that might just to, instead of dragging it out for an hour and a half in a single episode, could split it into 2 so that I can cover everything that's been covered. So that's the platform. That's the format. For now, all I will tell you is that markets actually got a reality check last week. So it was a bad one for the markets, is all I'm going to tell you right now. When a combination of negative trade developments and weak economic data, and when I say weak economic data, I want you to think broken jobs report or weak jobs report in the United States. That's exactly what has happened. It created a roller coaster ride for equities. When the dust had settled, and after setting record highs for the last few weeks, all 3 indices fell off a cliff. The Dow was down 2.9%, S&P 500 was down 2.4%, the tech-heavy NASDAQ was down 2.2%. To give you a much clearer picture of how much of a roller coaster ride it was for equities, the volatility index, CBOE VIX, jumped 36.5% for the week, a number not seen anytime soon. So it was a pretty grim week. Markets, I would like to update you, the markets have rebounded and they seem to be back on track again. But again, only time will tell whether there is any twist or turn, because until Friday, 4 p.m. Eastern, the market stopped trading. We'll never know exactly how the roller coaster is going to be. But as things stand, a lot of the Friday's losses have been reversed on Monday, and yesterday they were slightly down again, but more or less the momentum seems to be back in the markets once again this week. Whether it will stay that way, you will have to wait until episode 137, which is the next one. So once again, promise you I will have a very detailed Doctor's Weekly Snapshot segment next week. Like I said, might even do a separate episode dedicated to it. But for now, I'm taking you straight to the India this week. In other words, I'm going to welcome you to the Doctor Goes Home segment. And I know the biggest news coming out from the Indian market's perspective is the drama surrounding the India-US trade deals. I will cover this next week when things become a lot more clear. I mean, to be honest with you, I was doing some research. I was doing a lot of research on preparing for this episode. Wanted to see whether I can fit in the trade deal concept, the trade deal drama into the whole, episode. And to whether I can give you guys the full picture, because that's what the whole show is about, right? It's all about giving you guys the full picture. But it looks like, but then I realized that the RBI meeting is actually happening as things stand. I mean, it must actually, they must have released it right now about their rate cut decision or not. And I wanted to wait until RBI releases its full commentary on the trade drama, on how it sees the trade drama, and then put it all together and then give you the whole picture. So that's why I'm going to do the segment on India's trade deal, the drama with India and US when it comes to a trade deal. A lot of political drama, a lot of political fist fighting. President Trump's been absolute bonkers when it comes to India. So it's a lot of things are going on in the background, but a lot of things. I mean, but I wanted to fit the RBI story as well, and then take you through the full picture of the India-US trade deals. But this week, I have to talk about the Indian automakers, especially since, as always, a new month means on this show, it's time to take a pause on all the market action and focus on the Indian auto sales number. The good thing is, July was it's sort of a relief month for Indian automakers as far as I'm concerned. With passenger vehicle sales seeing a marginal increase of about 1%, marking a slight recovery after 2 months of decline amid sluggish consumer demand. More specifically, total sales came in about 348,000 units for July 2025 compared to 344,000 for July 2020. It was a marginal 1% increase, and any increase these days is much better, especially after you've seen 2 months of sustained decline in demand. Let's get to the top car makers individually. As always, India's largest car maker, Maruti Suzuki, reported a 3% year-on-year growth in total sales, reaching about 180,500 units compared to a little over 175,000 units in the same month last year, primarily driven by export performance, which surged 32.3% year-over-year. Surprisingly, the UV segment had another month of decline. I mean, UV segment of Maruti is considered to be one of those that I thought would never fail to find demand. But it's had another month of decline along with the mini segment. And what is very surprising is that the compact segment, and I'm talking about the likes of Bolero, Desire, Swift, that was the only segment that registered some form of growth, which is a surprise in itself, given that this segment has been going through a sustained period of declines for months. Not talking about weeks, for months. It's like month after month after month after month after month after month after month. Mini and compact segment have been going through a decline. So it was nice to see a positive surprise. Whether it'll stay like that way or not, only time will tell. However, make no mistake, forget it was mini, forget compact, forget UV. Make no mistake, the star of the show for Maruti in July was the company's exports. Without that, it would have not looked pretty. It's not looking very pretty, but it would have not even looked this pretty in terms of the sales number. Hyundai Motor reported a 7% year-over decline in total sales for July, a little over 60,000 units sold compared to a little over 64,550 units sold same period last year. Domestic dispatches to dealers dropped by over 10%. So Maruti, if you're thinking Maruti or sluggish demand, Hyundai has been falling off a cliff, and I'm an investor in Hyundai. So it's not been very particularly great for an investor like me, and for you as well, and for you as well if you've invested in the South Korean giant. So there is So domestic dispatches declined by over 10%. Exports, however, marginally increased, indicating some resilience in the overseas market, some continued resilience in the overseas market. A noteworthy development is that the SUVs made up 71.8% of Hyundai's domestic sales in July, and this is their highest ever proportion, with the Creta continuing its strong performance and market leadership in the mid SUV segment. I've always been a huge fan of Creta. If you've been following me for 36 episodes, nearly 4 years, just realized next month would be 4 years, then you kind of know that how much I've told you about Hyundai ever since they introduced the Creta, and then the Creta EV, and then the upgraded models of Creta. It's been a huge hit among the Indian consumer. So Creta making 71.8% of Hyundai's domestic sales in July is a milestone well deserved. I don't see much surprise in it, but it is the first time that it's hit. And for me, the surprise is it's taken so long to hit it, right? Now, despite the overall softness in the auto industry, Hyundai management remains optimistic about the upcoming months, banking on the festive season and an expanded product lineup to improve performance. The company is also enhancing its manufacturing capabilities with a new plant in Talagaon. My favorite auto name next, Mahindra & Mahindra, took its momentum into July. There is no stopping this giant, delivering yet another double-digit year-over-year growth in overall sales. More specifically, recorded a 26% year-on-year increase in total sales for July 2025. With its growth with the growth driven primarily by robust SUV sales and strong performance in its commercial vehicles, three-wheelers, tractors, and exports. UV sales, so SUV sales in the domestic market rose about 20%, buoyed by successful models and the launch of new variants such as the XUV 3XO REVX, BE6, and the XEV 9E electric vehicle. Total exports across all categories grew a whopping 83%. So it's been a twin performance from Mahindra & Mahindra, both domestic and exports, done really well. Company executives credited the success to new vehicle launches, robust demand for flagship SUVs such as Scorpio N, XUV 700N, Thar, and improved rural cash flows benefiting tractor demand. When the monsoon's been very good, so tractor demand, I don't see this tractor demand trend about to fall or something. I think it's doing a phenomenally good job, and monsoon conditions continue to be favorable across the country. So favorable monsoon conditions, like I said, also supported the rural and agricultural market strength. Overall, all I got to say is my new favorite auto name. There's a reason why it's my new favorite auto name, and my new favorite auto name, M&M, posted the highest growth rate among India's major automakers in July, with significant gains in SUVs, three-wheelers, exports, and tractors, thereby maintaining a leadership in several critical segments despite intensifying competition. Finally, my ex-favorite auto name, no longer my favorite, might be a number 2. We'll never know. I mean, I'm still debating whether I put Bajaj Auto over Tata Motors, but again, two-wheeler, four-wheeler, different story. But anyway, moving on to Tata Motors, which has gone down from my favorite to my second favorite. Not that it matters. It had yet another month to forget, though. I still hold on to shares of Tata Motors, by the way. But, if the performance is like these, I might have to actually consider. I know I've told you guys before I've considered, but then if performance improved, stayed on with the name. I'm getting a little impatient because I've got some other investment opportunities that I have found attractive. Such as Maruti. I'm looking at Maruti again, simply because Maruti is now, I don't know whether you recall this. I don't know whether you've read this, but Maruti has actually got the authorization from its board to diversify into non-auto segments. And I'm talking about things like auto financing, drone making, so on. And if there's one company that can do it all, it's Maruti, given its legacy and given its history. So I'm looking at it. It's pricey, so I'm looking for any sort of pullback to see whether I can. And then I might, I'm not saying that I will, I might rotate some of my money from Tata Motors, some of my investments from Tata Motors into Maruti. So that's something I'm looking at. But anyway, long story short, we're coming back to Tata Motors July sales. It had yet another month to forget. The PV sales declined sharply once more by 12% year over year. And the only solace was the company's EV segment, which grew by a robust 42% year over year, which is impressive given the fact that the competitive landscape has changed. And with Tesla about to make its entry, it's going to further change. Now, this was also Tamo's highest ever monthly EV sales and reinforcing its leadership in the domestic EV market. What a time to actually reinforce, in my opinion, given the fact the competition is certainly getting very strong. On to two-wheelers now. Hero MotoCorp continued its growth momentum, delivering a 21% year-over-year growth in total sales in July. The growth was driven by both strong domestic demand, 18.7% year-over-year growth, no small number, and a 64% surge in exports. The company's premium electric brand, Vida, achieved its highest ever monthly volume with 11,226 units dispatched and more than doubled its EV market share by volume to 10.2% year-over-year. Retail activity remains stable. Company expects further volume growth with the onset of the festive season. My favorite two-wheeler name, TVS Motor, continued its stellar growth, registering a 29% year-over-year growth. Exports continued to surge for the company, this time registering a whopping 48% year-over-year, 46% year-over-year increase for July. Royal Enfield also continued its upward trajectory, primarily driven by exports, which surged 95% year-over-year for the month of July. And finally, Bajaj Auto continued its positive momentum. It's getting there. It's slowly building back its momentum after a few months of declines. The domestic and exports this time aided its growth. In June, it was only exports that aided its growth. in July, both the domestic has finally caught up with it. Bottom line, that was all the numbers, right? All I got to say is while the growth of India's PV sales for July were marginal, there seems to be a lot of cautious optimism about accelerating sales during the upcoming festive season, particularly driven by new launches and improving consumer sentiment, especially in rural areas. Thank you to the rain gods. There are certainly reasons to believe this. For instance, according to RBI data, auto loans surpassed home loans for the first time with a year-over-year increase of 10.8%. This trend reflects changing consumer borrowing priorities with vehicle financing gaining prominence over traditional home financing and evolving economic conditions and consumer preferences. So the fact that there is demand for auto loans itself is an indicator that this particular increase in sales that we witnessed in July might be there to be sustained. It could be that be sustained. Now, make no mistake about it, challenges certainly remain. Okay. Now, while the Indian auto exports, the surge seen in Indian auto exports is unlikely to be dampened by the recent President Trump's tariffs, something I will talk in next episode, some form of pain will certainly be there. Make no mistake about it. At the same time, to what extent the recent layoffs that are cropping up, especially in the IT sector, you must have read this, TCS has slashed 12,000 jobs, could impact the auto sector also remains unknown. There was an article that said auto companies are worried, but they couldn't put a number on it. I mean, because we don't know whether it's a TCS centric only or whether this thing has all spread across multiple sectors as well. Companies such as Mahindra and Mahindra and two-wheelers should be expected to benefit, however, especially thanks to the continued strong monsoon seen this year, which should boost demand in rural region for two-wheelers and for M&M's tractors. So any tractor companies stand to benefit as well. I can't believe the festive season is nearly upon us. I mean, I remember doing the show, last festive season, then we moved into January, and then we discussed all these auto sales for different reasons. And now the trend is back. Festive season's back. Can't believe time is really, really flying. Festive season is nearly upon us. In the next few months, this would dictate the sales momentum. Whether the momentum can be sustained or not will be purely determined by the demand driven by the festive season or the lack of demand for whatever reason, even though festive season's there. So you can look at it both ways. And given that auto sales are still a bit of a slumber, 2 months of decline, 1% increase, not really, you can't really say, oh, it's out of the trouble, it's out of the woods, it's the trouble's over. No, can't really say. So given that auto sales are still in a bit of a slumber, this festive season, in my opinion, is more important than ever for India's automakers compared to previous years. As an auto investor, all I can tell you guys, if you're a fellow auto investor, is I certainly hope the likes of Diwali and Onam are the catalysts that would wake up India's auto giants. On that note, I am going to take you straight to Dr. Dissects. A cybersecurity giant is going under the microscope this quarter. The company that I'm dissecting this week is none other than Palo Alto Networks, ticker symbol PANW. Take a sip of water. Also get my notebook and pen ready. We've got to do the valuation at some point, right? Right. Now, I'm not going to talk about the quarterly numbers a lot because Palo Alto did report its Q3 numbers about 2 months back. The Q3 numbers impact has already been baked into the markets. There's a lot of takeaways that I wanted to know since the last time I talked about this company. All I'll tell you is it was a decent quarter with a beat on both the top and bottom lines. The company also issued a very strong guidance for both Q4 and for the overall year. Now, one of the key announcements that Palo Alto Networks made in recent times, one that has been referenced repeatedly throughout this fiscal year, is the company's target of reaching $15 billion in annual recurring revenue, or ARR, by 2030. One of the catalysts, that the company is betting on to reach this target has been its next generation security, or NGS offerings, which includes the likes of Prisma Cloud and Cortex. Now, if one looks at the progress of this metric, of the ARR metric, then one should have the confidence the company remains on track to hit the $15 billion target. While the year-over-year growth of NGS ARR has not followed a straight line in absolute terms, the NGS ARR has been increasing steadily with each passing quarter. Q3 was the first quarter when the metric crossed $5 billion milestone, and based on Q4 guidance, the $6 billion is not far off either. And one of the key factors behind the steady growth of this metric has to do with the AI revolution. As more and more companies utilize AI at the workplace, AI cybersecurity has become even more critical. This particular urgency has aided Palo Alto Networks' growth, especially given the demand for XCM, the company's AI-driven security operations platform. XCM saw a more than 200% year-over-year growth in ARR in the most recent quarter, and it was a major catalyst behind the company's overall ARR growth for Q3. In line with the strong demand for AI-related cybersecurity offerings, the company also announced a comprehensive AI security platform called Prisma AIRS. In addition, the company also announced that it would be acquiring Protect AI. Protect AI is an expert in dealing with cybersecurity applications, specifically in AI and machine learning domains. Now, I also want to let you know, and there will be a more update on this in the coming weeks from me, Palo Alto Networks recently made a $25 billion acquisition announcement of CyberArk, another security company, which is further expected to solidify the company Palo Alto's offerings, as well as its AI, next NGS ARRs, as well as its AI, AI ambitions. Let's put it that way. 25 billion. Don't forget the number. I'll give you more updates on it. But given the fact that the acquisition is still going through it's still just been announced, not closed. Waiting for more details. Put it together. Next time I talk to you about Palo Alto, I will be talking about, in detail about CyberArk, but I wanted to keep that in mind. It's not just Protect AI. They've also acquired $25 billion CyberArk as well. Now, Protect AI is, like I said, is an expert in dealing with cybersecurity applications. And given that the company is already a leader in the AI security space, and given that it has formed with partnerships with the likes of Microsoft and Databricks, Palo Alto Networks is acquiring a company that should allow it to accelerate its platformization strategy at a faster pace than before, given that AI's AI cybersecurity market is expected to grow substantially in the coming years. With respect to the company's platformization strategy, the very recent quarter offered more evidence that the decision to pivot to the strategy last fiscal year continues to pay off. The number of platformization deals has been steadily increasing with each passing quarter. And the company's next generation security offerings played a major role in aiding this growth. With Prisma AIRS and the acquisition of Protect AI and CyberArk, the AI cybersecurity platform that the company is planning to offer should accelerate the overall growth of its platformization strategy. Overall, on the face of it, investors may have felt that Palo Alto Networks Q3 was nothing special. This was declined by the declining stock price, and the stock has completely broken its momentum. I'll let you know in a bit. But when one digs deeper, then there is enough evidence to suggest that the company remains on track to achieve its long-term goals. And no matter how challenging the macro environment may be, given the AI revolution, the cybersecurity space has become more important than ever. With Prisma AIRS and the acquisition of Protect AI, as well as, like I mentioned, the $25 billion mega deal announcement mega deal acquisition for CyberArk, Palo Alto Network, in my opinion, has laid the foundation to not only achieve its goals, but also to remain well positioned to be a global leader in this space in a long time. I'm a huge fan of this company. I don't hold it. I don't own it yet. I keep coming in and out depending on the valuation, but I don't hold it yet. But I'm definitely looking. It's in my watch list for sure. Now, got the pen. I'm sorry. Got the pen. Got the paper. Must be blind. I so need my glasses back. I've placed the order yesterday. They hope they come soon. Right. So valuation, Palo Alto Networks. Company now expects FY25 diluted non-GAAP EPS to come in the range between $3.26, so $3.26, $3.28. Now, last time I talked to you about Palo Alto Networks, I said the company has consistently exceeded its high end of the guidance by an average of 2.1% every single quarter for the past 8 to 12 quarters, so 2 to 3 years. I've assumed that the company would beat the FY25 guidance by this magnitude, so about 2.1%. So it results in a projected FY25 EPS of $3.35. Now, this would imply that Q4 diluted EPS would need to come in at about 96 cents or 9 cents higher than the consensus estimate. Company has beaten the consensus by this margin before, and as such, this is a reasonable estimate in my opinion. The new assumption is slightly higher than my previous assumption, which was $3.22. Now I'm expecting $3.35. The company, according to Seeking Alpha, currently trades at a forward PE of 52.8x. Lower than its 5-year historical median multiple of 57.7. Now, Palo Alto's long-term average EPS growth, according to Seeking Alpha, stands at 22.6%. Based on my projected FY25 EPS growth would be 18%, so marginally lower than its long-term average. As such, so I'm not going to go to 57.7, but I'm also not going to 52.8 because there's enough catalysts around. So what I'm going to do is I'm going to stick to the same multiple as last time I talked to you, which is 54.8x. Forward P of 54.8x. Now, according to Seeking Alpha, Palo Alto Network currently trades. Now, this is the scenario analysis building. Okay, so it currently trades at a PEG ratio of 2.56, higher than the sector median of 1.80. And Palo Alto's 5-year average of 2.43. So current PEG is 2.56. Industry median is 1.8. 5-year average 2.43. Now, what I'm going to do is for the PE, I'm going to put 54.8 across all three scenarios. And that would put EPS growth projections for FY26. Got the numbers here. Let me quickly take the numbers here. That would be 21.41, 30.44, and 22.55. And then I'm going to put the EPS at $3.35 across all three scenarios. And FY26 EPS be 4.07, 4.37. I'm going to show the table to you in a bit, 4.11. And then the price target would be 223, 239, 225, an average price target of 229. So here's how it's worked. So I've got all the PEG ratios here, 2.56, 1.8, 2.43. Then the price to earnings forward doesn't change, 54.58. And then obviously the EPS growth is PE divided by PEG. So that would put 21.41 here, 30.44 here, and 22.55 here in this scenario. And then the EPS becomes 335, 335, 335, no changes there. And then FY26 projected EPS becomes $4.07 in the first scenario, $4.37 in the second scenario, $4.11 in the third scenario. Then the price target simply becomes 54.8 into $4.07 and so on. You get these three different price targets. You take the average price target for me becomes $229, which actually represents, believe it or not, 35% from current levels. And this is because this brings me to the very important point. According to Seeking Alpha, it has absolutely horrible momentum. This is a broken stock as far as I'm concerned for now, because its short-term momentum grade is D. Okay, not completely broken. It can go up to F, but D is still bad. Okay. So what I'm going to do is there are catalysts for the company. Okay, a catalyst for the company. Price target represents about 35% upside from current levels. Weak momentum, however. So I'm not going to upgrade from hold to buy, hold to strong buy. I'm going to upgrade to hold to buy. And when I say hold to buy, I mean this is not a conviction buy. This is a buy on any weakness. Maybe you can start accumulate a little bit today, and then once it should it fall further, which given the fact it has a weak momentum, it may. Then you buy a little bit more, and then because the momentum is due to shift for this company, make no mistake about it. It's a fine name. After CrowdStrike, this is a brilliant name. It's one of the names I've held for multiple times now. This is not a recommendation. This is what I would do. So all I'm telling you is, from my opinion, price target 229, 35% upside from current levels. It's not a conviction buy. It's a buy on any weakness, and it's basically accumulation strategy, rather than going gung-ho as a conviction buy. So buy rating, I am upgrading the stock, however, because last time I talked to you, it was a hold rating. Now, a buy rating can only mean one thing. Got to discuss the risk factors. Two risk factors to discuss. First, Palo Alto management during the Q3 earnings call assured investors that the company itself remains immune from any tariffs. The same, well, this may be true, same cannot be said about its clients. Moreover, one of the reasons why the company couldn't maximize the quarter was actually because of tariff-related disruptions its clients faced in April. Remember the reciprocal tariff Liberation Day. The tariff-related uncertainties aren't going anywhere, and should the disruptions continue or get worse, the company would face an indirect impact via its clients. This would once again not allow the company to maximize its potential, thereby affecting my bull case for the name. Second, any acquisition, there's always risks involved. So the other risk factor that investors should consider, in my opinion, would be if the acquisitions of Protect AI and CyberArk don't pan out as expected. Now, during the earnings call, CEO Nikesh Arora mentioned that the rationale behind the acquisition of Protect AI was to enhance its AI portfolio by integrating AI runtime security. Mr. Arora mentioned that the acquisition fast-tracked this process by saving the company about 6 months to build it. Should the synergies, however, fail to materialize, then it would definitely have a negative impact on the company's AI offerings. Company might have to go back to the table again, which would subsequently negatively impact my bull case. So you got to consider these risk factors as well. Anytime I put a buy rating out there, there's always risk factor to consider as far as I'm concerned. Now, bottom line, it was a decent quarter from Palo Alto Networks, marginal beat on both the top and bottom lines. However, like I said throughout the segment, next generation security ARR really stood out for me as it crossed the $5 billion milestone. Furthermore, the company also announced Prisma Airs, a comprehensive AI cybersecurity platform, as well as its intent to acquire Protect AI, a leader in the AI cybersecurity space. The new offering, along with the acquisitions of Prisma Airs, plus Protect AI acquisition, plus CyberArk acquisition, should enable the company to further grow its platformization strategy, which continues to remain on a solid footing. At the same time, in my opinion, and this is why my bull case is, my upgrade has come from hold to buy. The company has laid the groundwork to ensure that it achieves its long-term goal of $15 billion in annual recurring revenue by 2030. From valuation upside, I already said that remains considerable upside from current levels. So I am upgrading my stock from a hold to buy. However, keep in mind the weak momentum. I wouldn't put all my eggs in this name, all the money that I set aside for this in one go. I would probably put a little bit, and then if it goes down by a little bit more, still goes down by a little bit more, it's an accumulation strategy for sure. This is a buy on any weakness name. This is not a conviction buy, given the fact it's got horrible momentum as things speak. AI revolution continues to chug along even when the macro environment remains challenging. As such, cybersecurity has taken on more importance. And based on all the analysis I gave you today, one thing's for sure, Palo Alto Networks is going to be at the forefront of it when cybersecurity and AI really, really do take off. That's all the time I have for you this week. If you have a specific Indian US stock suggestion for the doctor to diagnose, do tweet me at UTHAMVINAY or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I'm very sorry it's a very shortened episode today with only 2 segments. I will be back with the full show from next week onwards. A little bit of fully recovered now, but it took some time for recovery. So apologies for that. Thank you once again for listening, guys. I will definitely see you next week. Until then, stay safe and make some money.